Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Fresh new week, counting down the days now to go for the end of the year, wrapping out 2025. This is, Bazaar Morning Call. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant, with me, my colleague Surabhi and Nigel. Guys, morning.
Hi, morning.
Hi, morning, folks. So 10 days to Christmas and just about 15 for this year to roll over. Markets more or less in a range, but I think on Friday we had evidence that the bulls are not willing to throw in the towel. They're fighting back. Hopefully we'll have more of that this week.
Well, that's right. Last couple of trading sessions, at least some signs of stability, some sign of hope that maybe towards the end of the year we see some kind of green on the screen. So hopefully these FIs go on a break, all the sellers go on the break, and in fact the markets can have a bit of a melt up. But interesting times. Hopefully the recent form that we saw continues with the bulls.
Well, Thursday and Friday were better, much better as compared to the prior few trading sessions. So let's take it from the top then in terms of where we are at, right? Where we find ourselves at. So, I mean, we're not talking about weeks now to wrap up 2025. We're talking about days in that sense. And by the way, 13 days to go. Around 13 days. This is 13? I think 13 or 14 days to go to end 2025 and, go into 2026, right? So it's the end of the year, it's that time, and but action, etc., has been pretty robust across global markets. I mean, it's not really tapered off, and I think now it will start. Especially foreign investors go on leave, and even here, I mean, some of the larger investors are already out or maybe getting out as well. I mean, so year-end breaks perhaps does affect markets, and it's generally expected to be a quieter part of the year. Now, U.S. equities on Friday were lower. NASDAQ down about 1.7%. That's a sharp cut, right? S&P was down little as compared to the NASDAQ, 1.2% lower. Broadcom, which is the chip maker, shares fell 11% after it reported numbers, and earnings basically raising questions about their outlook for their top line, sales forecasts. So the numbers, once again, from Broadcom, highlighting concerns around valuations vis-a-vis, the entire AI boom and all the companies which are kind of linked to it. Oracle was down another 4.5%. By the way, just think about it, right? If you look at the technology pack in the US, two big companies reported numbers. And on the day they reported numbers, both shares fell 11% respectively. Oracle, when they reported numbers, fell 11%. Broadcom on Friday fell 11%. And Oracle was down another 4.5% on Friday. So, it's for now not causing too much anxiety. Oracle specifically, of course, we can maybe talk about more there. That is being seen as perhaps the most overstretched in that sense. Intel is said to be, talking about more AI deals, etc., it's said to be in advanced talks to acquire another AI chip startup for about $1.6 billion. So that's it. I mean, no stopping deals and deal-making in the AI space. Now, President Trump spoke with Wall Street Journal, and he basically said that he's leaning towards choosing either Warsh or Hassett to lead the Fed. And, of course, I mean, the indication that he publicly signaled was that earlier, this is about a week and a half back, that Hassett perhaps has got the job. But he's saying, well, it's either Warsh or Hassett. And he essentially called for aggressively lower interest rates. He said, well, interest rates should be 1% and maybe lower than that. So that's quite something. By the way, you have Kevin Hassett, who's on record to say that President Trump can, express what he wants, but he can't dictate policy. But I guess that's more that's more for the public in that sense. He's very much President Trump's man in that sense. Now you have jobs data which will come out, and I'm just putting it out because usually you get it right around market opening on a Friday. This time the November jobs data, which has been, of course, the release has all been muddled up because of the earlier shutdown. It's going to come to us on Tuesday evening, and we'll react to it on Wednesday morning. That's the jobs data. Consensus expects about 50,000 odd addition in terms of non-farm payrolls. And with regards to Russia, Ukraine, President Zelensky, and this is important, he's basically, he's indicated that his prepared to forego its ambition, Ukraine's ambition to join NATO. This was the crux, the nub of the entire issue. Russia's basic problem was that Ukraine cannot join NATO, and NATO should stop trying to woo Ukraine into its fold. Now, finally, after 3.5 years and I guess 1 million dead, President Zelensky of Ukraine is saying that we are prepared to forego our ambition to join NATO, provided safeguards, etc., are given. So we'll see how this. By the way, I think there are talks in Berlin on yesterday, and they're expected to continue today as well. US, of course, has been pushing Ukraine to accept the peace proposal. So will this now come to a head and something happen quickly? Will be good that if something does go through in terms of a ceasefire and a peace plan. Now, the cabinet markets in India looking much better, as I said, Thursday and Friday. Cabinet has cleared the insurance amendment bill, but without a lot of punchy stuff which we were expecting. And we'll talk more about this in a little bit. Parliament will take it up today around 12 o'clock is what we understand. 20-day moving average for the Nifty, 26,031. We are very much around that level. Nifty Bank 20-day is about 59,268. And supports basically, I'm not looking at the November low, but recent lows, 25,750 on the Nifty and 58,850 as far as the Nifty Bank goes. GIFT Nifty will give you a quick sense of how we're likely to start, and then we'll pick it up from there. 90-point lower start this Monday morning is the implied open. How's the futures and options positioning looking? Nigel has walked across for that. Nigel, over to you.
Well, the bulls will be interested actually looking at the downtick that we're seeing on the GIFT Nifty, because if they wanted a bit of a dip, that's what's going to happen. So let's see whether or not that dip can get bought into, because the last couple of trading sessions actually have been quite good. So in Friday's trading session, yes, the Nifty ended up. But the good news was that the Nifty Next 50 and the mid and the small caps, they did even better than the Nifty, which was encouraging to see. In terms of flows, well, the DIs, they bought, the FIs net sold. But net, if you look, between them, the institutions were net buyers, and you like that. What do the FIs do on index futures? Well, they unwound some longs. They added some mild shorts as well. And now the short positioning is at around 90%, which is the highest that we've seen in the last 2 months or so. As I always say, a net short market is not such a bad thing, because if these FIs don't get follow through on the downside, or even if you go through a phase of consolidation, then they're tempted to cover the shorts, which can actually give a bit of a bump up. In absolute terms, it's around 1.5 lakh contracts net shorts from the FIs, in percentage terms at around 90%. The other encouraging sign was that both the clients as well as the FIs, they wrote puts in Friday's trading session. And because of the kind of put writing we have seen, the PCR has gradually moved up. I recall, when we went to around the 25,700 mark, I was saying that, at around 0.63, 0.64 odd, you normally see a bit of a bounce when the PCR gets stretched on the downside. Currently, it's around the middle level at around 1.15 odd, because the puts, we saw the 26,000 put, 25,950 put, both of them put it together, more than 1 crore shares were added at both these two strikes, which brings us the levels. The low that we saw on Friday, around 25,938, 25,900, 25,938, that's going to be the important mark. And the reason I say this is because, we are seeing a fair bit of writing at around that 26,000 a put. On the upside, the high, that we saw recently, 26,326, that'll be a level that the bulls will want to get to gradually. The Nifty Bank has returned back to its form. Though in Friday's trading session, it was a relative underperformer. Now, the important market needs to support is at around, that 58,650 to around 58,700. And I say this because numerous times we went to those levels and then we bounced off from there. So that's going to be the important level to track. In terms of stocks that we're looking at in Friday's trading session, I wasn't there, but I recall in Thursday in the final hour of trade, I said that Sammaan Capital, there is a possibility that on Friday it could possibly come out of the F&O ban, and that's happened because there has been some unwinding of positions. So I'll keep an eye out on this stock, and the other one is going to be Vedanta. I put out a piece with regard to aluminium. Can it look up for the next couple of years, going by the kind of details we have on the global front? So Vedanta has aluminium exposure, which is the highest percentage of its SOTP. And then there's silver exposure coming in from Hindustan Zinc as well. And silver's been doing well. So I'll keep an eye out on this name.
Okay, absolutely. Indeed, those metal stocks have been shining bright, the best part of the market for most of last week. By the way, as we kickstart our first conversation, just a roundup of Asia, because markets are not feeling very great this morning. There is a slide across indices. Japan, Hong Kong, Taiwan, the Australian market, of course, very, very unfortunate events, over the weekend with respect to what happened at Bondi Beach. Unbelievable. And our thoughts and prayers with those who were affected. Most Asian markets are down. There's fresh data out of China, and all of it is negative. Retail sales lower than expectations, industrial output number weaker than expectations, and the fixed asset investment continues to be in contraction zone for the entire year. April to now. So numbers out of China are very weak, and in general, there is a sell-off across the Asian region. Now, where does that leave us? Let's pull up the GIFT Nifty in the implied open, because the bulls managed to wrestle their way back to the 26,000 mark on Friday. But the problem is that that's become a bit of a very, very strong resistance zone for the market. And the implied open is suggesting that we'll start lower by about 80, 85 odd points. So let's see how it goes. But in general, a sense of caution this Monday morning in global equities. Matt Orton, Chief Market Strategist at Raymond James Investment, is with us. Matt, thank you so much for joining in. Oh, that's a lovely looking tree behind you, looking very, very festive.
Thank you.
Are you getting set to wind down the year, or are you going to work through to Christmas? And if yes, are you buying any more stocks here in India?
Hey, good morning, Serbia. Unfortunately, this year doesn't really give you opportunities to turn things down too much. There's plenty of catalysts that are still left to come between now and the holidays. And then if the markets may have a Santa Claus rally, you certainly don't want to miss out on participating or making sure that positioning is properly squared. I still remain quite optimistic on India. I remain optimistic globally on markets. And outside of the US, again, I think India has the chance to outperform the rest of the emerging market complex, or at least certainly exceed its performance this year. With respect to new names, I'm not looking at adding any new names right now into the portfolio, but I am thinking about where to tweak or adjust weights. So especially given some of the underperformance names like a Swiggy, which is one of the newer names, I think their capital structure and their access to capital is going to help them compete and be a number 2 player in quick commerce. That's a name I'm thinking about adding some weight to if we can get a nice, strong momentum behind it. And also thinking about making sure weights to some of my winners this year, like Mahindra, HDFC Bank, Adani Ports, how I want to have that structured into next year, where I do think all of those names can continue to perform well.
Hi, thanks very much for joining us. And, Merry Christmas in case we don't speak with you, before and between now and Christmas, really. So just a quick word, if I can. I mean, President Zelensky essentially finally indicating that he's ready to forego NATO ambitions, this should do it, right? I mean, this was the crux of the entire thing, and if they say that we'll never ever join NATO, and sign, I mean, if he's ready to do that, then I mean, there should be path to peace.
Yeah, Prashant, it's a good point. There should be a path to peace. Now I think Zelensky is putting the ball squarely back in Putin's court to see if he's actually serious about where we go. And I still don't think Putin is that serious about actually trying to have peace. He's kept a wartime economy going, and I think as a result of that, unless Putin gets all the territorial concessions that he wants, I don't think he's willing to give up anything in this negotiation. As Trump has also highlighted, both parties have to leave unhappy in some respects if you're going to have a good negotiation. So I'll be curious to see where this goes moving forward. But one of my key themes in my outlook for 2026 is continuing to play offense with defense. Whether or not this war gets resolved or there's another détente put in place, the need for different regions around the world, Asia Pacific, Europe, North America, the amount of investment that's going to be need to made into smart missiles, smart defense going forward, I think that's a huge opportunity for investors going forward. And that's an area I still want to make sure that my portfolios are well positioned for leading into 2026, because I think that's a very durable, long-term growth theme.
All right. Hi, Matt. Good morning. Good to see you, Ben. And I'll tell you what, I don't think we are speaking for sure in 2025, because I'm off to the races next week itself. That said, I'm hoping, Interglobe, or Indigo as we commonly call it, gets its act together, on a customer front, because I'll be flying out, going for my holidays with my kids. But that's a stock that you have liked in the past. It's pulled back 20%. They seem to be trying to get the house in order now. What's the view? Do you think it's providing an entry opportunity? That's a very lean and mean machine, as we've been talking about. Your take?
Absolutely, Nigel. Interglobe is definitely a lean operation. I think that's why it's going through some of the challenges that it has right now. There are risks to buying this dip, though. I've had significant gains in the name, so it's okay to still keep a position. My weight has been reduced given the events that have taken place, but I wouldn't be a dip buyer right now until we know how regulation might shake out. If there are any sort of regulatory changes that are made with respect to Interglobe, I think that could be challenging for the margin picture of the company going forward. So I would wait to see a little bit more clarity in the name. And if the operating environment remains just as it is today, I think then the dip becomes viable. But I'm okay waiting to buy that dip. And instead, I might actually look into areas like IT services that I have not liked for all of 2025. But you're starting to see some green shoots, especially names like TCS is interesting to me. I'm looking at it. Going back to Serbi's first question, while I haven't added it to a portfolio, I think there's reasons to believe that you could see margin improvement, both through M&A activity and through their focus on implementation with new technologies. So that's one to keep on your radar if you are looking for a discounted name in 2026.
Okay, all right. So that's one more name, more ideas there from Matt. Matt, thank you so much. And just in case we don't speak now, up until Christmas and New Year's, wish you happy holidays and a very happy festive season. Thank you so much for joining us today.
Thank you.
Well, with that, let's tell you what else we've lined up for you on the show today. At 8:30, we have Dharmesh Kant of Chola Securities joining in. We'll discuss some of the key fundamental stocks in focus today. At 9 a.m., Gaurav Malhotra from Axis Capital joins in to talk about trends in the telecom sector. At 9:20, Krishna Sanghvi of Mahindra Manulife Investment Management will be with us. He's our market master of the day. At 9:35, the management of BEML joins in to talk about their outlook for 2026. Towards the end of the show, in our special segment, It's the Economy, Lata will be in conversation with Bhavesh Jain of TransUnion Civil.
Time to slip into a short break. We've got a lot of stock-specific action to track for you. We get to that in just a bit in our special Top 10 segment. We're looking at Interglobe Aviation, Oro Pharma, Biocon, Keynes Tech, Usha Martin, Amber, TBO Tech, NCL India, as well as Godavari Power. All of them will be reacting to positive news flow, while Dr. Reddy's will be the one reacting to negative news flow. Take that break, come back, we get into further detail on all of these names.
Welcome back. Well, as promised, we'll get to all the stocks that are in focus. Qs, of course, are far more cautious. We've been telling you that. Most of the Asian markets are down, and the implied open is suggesting that we will also open down by about 80 to 85 points. That's the last. We saw the GIFT Nifty, now it's 95 points lower. So prepare for a gap down, and then we see what happens from there. As usual, it's time to get to the CNBC-TV18 list of top stocks to watch. Guys, morning to all of you. Hormaz, let's start with the Indigo. What's the latest?
Well, the latest is the fact that operations appear to be returning to normalcy. At least that's what the company statement says. They flew over 2,000 flights across Friday and Saturday with minimal cancellations. They also mentioned that the two cancellations that did take place were due to technical reasons and the fact that the passengers of those affected flights were immediately accommodated on the other available flights. Now, what the company has also said is that they'll be operating across all 138 destinations today, and that is indicative of operations returning to normalcy. So what this indicates is that the overhang is addressed as of now. The company has already cut its third quarter guidance as well with regards to some key parameters. So the next trigger that emerges will be the results and what the company projects for the fourth quarter and the road ahead as well. So for now, an overhang seems to be addressed. So going with green for Indigo.
Okay, all right. Thanks a lot for that, Hormuz. Well, let's hop across to Ekta. She's got a bunch of pharma stocks that she's tracking. Morning, Ekta.
Morning. Well, I'll start with Dr. Reddy's. I expect a mild red on that stock because the USFDA completed a pre-approval inspection of their Srikakulam facility and issued 5 observations. The inspection was from the 4th to the 12th of December. Aurobindo, the USFDA has inspected their Unit 5 API manufacturing facility. It was inspected from December 1st to 12th. They've been issued 3 observations. The company says that they are procedural in nature. Biocon, I expect it to possibly be in the green because they've signed a licensing agreement to commercialize their biosimilar aflibercept, which is basically used for ophthalmic conditions, and the licensing agreement is with Regeneron and Bayer. The agreement is for Europe as well as the rest of the world, and this follows an earlier settlement for the US and Canada. So they will be able to launch this particular biosimilar in the UK in Jan 2026 and the rest of the settled countries in March 2026. So maybe that stock would see some amount of green because it gives a pathway and licensing agreement for this particular biosimilar.
All right, Ekta, thanks very much for that. Well, Keynes, Tech and Usha Martin are the next two on our radar. Nimesh is here. Nimesh is back from his small break. Nimesh, morning. Welcome back.
Thank you, Prashant. So the first stock is Keynes Technologies, has been in the news for the last 2 weeks. Remember, the stock is down 45% from the recent highs. But now, interestingly, on Friday, Capital International bought nearly 4.5 lakh shares, investing close to 190 crores in Keynes Technologies. I know there was a lot of controversy around the accounting standards, but the management did clarify last week that they've addressed all the accounting as well as the collection concerns with the smart meters. And finally, they've said that they're going to exit the service model, and only supply smart meters going forward. So some bit of concerns aligned. And now that Capital has bought nearly 4.5 lakh shares in Keynes Technologies. So I expect some green in that name. The second name is Usha Martin. Interesting, block deal data there as well. The promoter entity sold nearly 23 lakh shares at an average price of 430 on Friday. Buyers include interesting names, including 3P, which is run by Prashant Jain, Morgan Stanley, as well as Bandhan Mutual Fund bought in that block deal. The company has reiterated 12 to 15% sustainable volume growth in the very near term. So expect that stock also to trade in green. But Keynes could be an interesting name because after all the controversy, Capital has bought nearly 4.5 lakh shares on Friday.
Okay, all right. Thanks a lot for that, Nimesh. Well, let's hop across to Upasana. She's here to tell us about Amber as well as TBO Tech. They had the analyst meets, I think. Tell us more, Upasana.
Yes, certainly, Nigel. Firstly, let me start with Amber Enterprises. The management has reiterated their guidance, implying a strong 13 to 15% outperformance to the industry in terms of consumer durable segment, is what they've said. The company has also indicated industry-leading growth in AC segment. They've also said that they are seeing much stronger growth, and also they are sticking to the stronger growth outlook in their other segments over a medium term. Most of the focus of the discussion was on their electronics segment, and companies also reiterated a robust medium-term pipeline through organic expansion projects. Now, TBO Tech also in focus on the back of analyst meet. The management says that it has underscored sustained relevance of offline agents amid rising luxury and experimental travel demand. Companies also scaling to AI tools to empower advisors, while partners like Emeritus Hilton to value its reach, curated content, and even service depth. So on the back of these positive commentary, expect both these stocks to open in green today.
Okay, so TBO Tech and Amber will be on our radar on the back of those analyst meetings. Thank you for that, Upasana. Let's get to Ria, who's watching out for NLC India and Godavari Power. Ria, morning. Tell us why.
Well, good morning. NLC India today will be in focus since they have received an LOA for setting up a 110 megawatt grid-connected solar PV power project in Uttar Pradesh. And separately, NLC India Renewables, which is a wholly owned subsidiary of the company, has signed a JV agreement with PTC India to set up a 2,000 megawatt green capacity project in phases. So the stock is expected to open in the green on the back of both of these news flows. The next one is Godavari Power. The company is going to enhance its BESS project capacity from 10 gigawatt hour to 40 gigawatt hour. Now they are going to set up a 40 gigawatt battery pack and container capacity for roughly rupees 1,625 crores versus their earlier plan of just 10 gigawatts for rupees 700 crores. This project is to be completed in 2 phases, and phase 2 of the project is to be done in FY29. This stock also expected to open in the green today.
Okay, all right, got that, Ria. Thank you very much for giving us the updates over there. Let's quickly recap our list of stocks to watch. The ones that have positive news flow around them are Interglobe Aviation, Aurobindo Pharma, Biocon, Keynes Technologies, Usha Martin, Amber, TBO Tech, NLC India, and Godavari Power. There's only one stock on the red side, potential, a negative opening. That's Dr. Reddy's. Okay, so that's the equity market roundup. Let's now figure out what's happening in the world of commodities. It's all those metals, precious or otherwise. They've been capturing investors' imagination. Manisha, good morning. What's on the radar for this week?
Well, Friday was a bit of a profit-taking, but Monday morning we are back onto gains when it comes to gold and silver. Support comes in from rate cut, robust ETF inflows, strong retail demand. rising lease rates, especially for silver, and then you are looking at a deficit in silver as well, which could continue for a sixth year in 2026. So very strong supports continuing for silver, which absolutely is outperforming most of those commodities and various other asset classes as well. The gains also have continued for copper, where LME is trading near all-time highs, and the U.S. copper price is trading at a 4-month high. Well, we have been talking about supply disruptions in Chile and Peru. It also is about the ore grades declining. The LME inventories have been falling as well, so that has been giving a lot of support to copper. I quickly want to touch upon platinum, which is trading at a 2011 highs right now. The strong Chinese demand clearly has been supportive for this one. But do keep an eye also on the cryptocurrencies, because you have Bitcoin slipping back below 90,000. There are concerns that Bitcoin-heavy companies perhaps could be removed from the MSCI indices, and that is bothering the companies as well as crypto markets overall.
Okay, all right. Thank you for that update, Manisha. We'll look out for more details over there. Right now, we have to take a quick break. On the other side, focus is going to be on the insurance sector. The Cabinet has approved the Insurance Amendment Bill, and it's likely to be introduced in the Parliament today.
Welcome back. Well, the Union Cabinet has approved the Insurance Amendment Bill, which allows 100% foreign direct investment into the insurance sector. The new legislation also aims to give more teeth to the insurance regulator. Sapna Das joins in to fill us in with more details on the proposed legislation. Sapna?
The expectation is in the coming week, it's going to be tabled in the Parliament, maybe as early as Monday. That's what we are getting to hear very clearly in terms of tabling of the bill. And there will also be a certain sense of urgency in getting it cleared as quickly as possible. So, all eyes on that, and there will be a lot of action in the coming week. That's one. Second, very quickly, of course, 100% FDI, raising the cap from 74% currently. That's a big one. It's more of a signaling by the union government. If you look at the current FDI, the kind of flows that have happened in the insurance sector, there is still a bit of headroom available even to reach 74%. So this is an important signaling from the part of the government to basically invite more foreign investment. Please come to the Indian market and put in money in the insurance sector. I think that's a message loud and clear. That's one. Second, some other important changes have also been proposed in the amendment bill. Number one, of course, is setting up a new consumer protection and education fund for the insurance policyholders. It was not the case so far. So that's one. Second, also giving more teeth to IRDA in terms of disgorgement of wrongful gains. Now, SEBI, as a market regulator, already has this power since quite some time. The same is now being given to the IRDA. Third, of course, also in terms of merger of non-insurance companies with insurance majors. Now, we did try to find out what this really means. So given to understand, say, for example, it's an insurance major has an SPV and they would like to merge it with the main insurance company. That's how it's going to be, or even non-insurance companies for that matter. So this is basically more in terms of promotion of ease of doing business and giving some kind of scale. Of course, post-merger, the insurance entity is what will continue.
Sapna, thank you very much for that. Parag Thakur is with us of Fort Capital. Parag, good morning. Great to have you with us here as we get into one more week and one more Monday. A few Mondays more, and that's the year. This insurance amendment business, right? From what Sapna is saying, what Cabinet has approved and what will be in the Parliament today at 12 o'clock, we understand, doesn't have two things. The composite license, which is that anybody can do anything. Life can do health, health can do life, etc. And second, it also doesn't have open architecture, which means that, an LIC agent can only sell LIC policy, can't sell any. But open architecture meant that, agents are free. This was seen as negative. So it kind of doesn't have, what Sapna is telling us so far, it doesn't have these two. This was some of the majority of the big bang, so to speak. So the big bang now is only that FDI bit and, some more. What do you make of it, Parag?
Yeah, I think I will have to read the final guidelines. Right now, my positioning is on Bajaj Finserv, which I feel is a fantastic play on NBFC as well as insurance. plus various businesses with their seeding like broking and AMC and all. And in insurance, remember Bajaj Group has bought out Allianz for 24,180 crore, 25% stake. I view clearly this as a promoter buying in Bajaj Finserv. Bajaj, so it means that Bajaj family is buying the balance residual stake of Allianz in its insurance arms for 24,180 crores. So I would say that, and Bajaj Finserv, if you see current market cap is exactly 54% of the Bajaj Finance stake which they hold. So I would say that it's valued very reasonably, and it's a Bajaj Group company, and it gives exposure to insurance also, both life and general, and both are going to grow very profitably. So I would say that this is my positioning, but I would like to read the final guidelines and understand it more properly before taking a bigger view on this particular amendment.
The other one, maybe we'll have a discussion lined up actually, is the merger between life and non-life. So Max Financial perhaps is the other one. I mean, from a near-term perspective, which perhaps could be in...
The holdco discount can be lesser.
Yeah, can be. Although we had Amitabh Chaudhary a couple of weeks back with us, but that's another bit, that Axis Bank, buying stake, and there was all that other bit involved with that, right? Investigation, SEBI is looking at the price. I'm not sure if that has any bearing on this. I mean, the merger itself between Max Financial and Max Life. Indigo, Parag. So we have this estimate now, which is pretty close to what CNBC reported on Friday, which is near about 500 crores. The compensation, and it'll be paid out in January. Stocks stabilized over Thursday and Friday. What from here, according to you?
I think if it is a 500 crore hit one time, it's okay for a business which has survived so many downturns and so many bad cycles in the past also. But just to clarify, I have not still bought into it. But I would like to say that the believers of airline industry as a sector and Interglobe can use this as an opportunity to buy because it is one time, and this cloud will also pass. So I think, but I have got enough other companies to buy. So I would say that I will wait. And plus, I have raised some cash also just ahead of this Bank of Japan meeting. So I would like to stay on cash for some time, 5-6% at least. But there are many interesting opportunities because I am very constructive on India as an economy from here on. And I would like to say that this particular foreign FMCG stocks, led by Hindustan Lever saying that our YOY will be flat EBITDA in Q3, I think I would use this as a good opportunity to accumulate on every dip.
Okay, all right. Parag, request you to stay with us. I want to ask you your view on Lenskart as well as Hindustan Zinc. For the time being, we'll slip into a short break. Come back. We'll continue our chat with Parag. Our technical experts will also join in.
Okay, welcome back. There's 15 minutes to go, a little more than that to go for the pre-open session to kick off. Hormuz is here with the big movers from yesterday. That is Friday, the last session, and what lay behind the price action. Hormuz, over to you.
Morning, Prashant. And a lot of metal stocks were in focus all through last week, and Hindustan Zinc was no different. It was the best week that the stock had since May of last year, 13% gain over the last week that you saw. Third straight day where over 1 crore and more shares were traded in a single trading session for Hindustan Zinc. Friday's volumes were the highest in 6 months with almost 4 crore shares being traded, with a 20-day average of close to 60 lakh shares. And out of those 4 crore shares, only 85.5 lakh shares were marked for delivery, and that is 4x of the 20-day average of close to 21 lakh shares. Now, the stock is still down around 30% from its record highs of around 807 that it had hit in May of last year, but still, of course, falls into that category of low free float stocks. Transformers and rectifiers is another name. It's been an underperformer, but it was among the top gainers in the broader markets on Friday. The biggest single day gain since January of last year. Volumes were the highest since December of 2007, and 6.2 crore shares were traded, the 20-day average of close to 40 lakh shares. And out of those 6 crore shares that were traded, only 46.5 lakh shares were marked for delivery, the 20-day average being around 13 lakh shares. And Friday's turnover, nearly 60% of its free float market cap, and the stock down nearly 60% from its 52-week high, which is close to 650 rupees. And lastly, Walchand Nagar was another mover in the broader markets, the biggest single-day gain that the stock saw since December of 21. Friday's volumes the highest since September of 2017. Volumes were the sum total of the last 28 sessions put together, with over 70 lakh shares that were traded. The 20-day average is only 3 lakh shares here. And out of those 70 lakh shares that were traded, 7.5 lakh shares were marked for delivery, the 20-day average being close to just over 1 lakh shares. The stock has had a disappointing year so far, down around 40% on a year-to-date basis.
All right, thanks a lot for that, Hormuz. In fact, let me take the point forward on one of the stocks that Hormuz mentioned. Now, Jefferies has initiated coverage on Hindustan Zinc with a buy rating, target price at around 660 rupees. They are valuing the company at around 10 times EV upon EBITDA. Let's run you through 5 key assumptions that Jefferies is making. They are expecting a sharp acceleration in earnings, more than 20% over the next 2 fiscals, 26 as well as 27, and 7% in FY28. Though we need to know that Jefferies EPS estimates where they're 9 to 31% above what the street is expecting. On valuations, well, they note that Hindustan Zinc, yes, it's trading at around 9.2 times EV upon EBITDA, which is above its 10-year average, but they believe that this premium is justified, given the increasing share of silver in the EBIT. Point number 3, their price assumptions actually are below the spot levels. On zinc, their assumption is 4% below spot. On silver, their assumption for the next couple of years is 3 to 10% below what spot rates are. We need to note that Hindustan Zinc, though, has hedged 37% of its second half of the year volumes at around $37 per ounce. So the full benefit of these higher prices that we're seeing of $50, $60, that will flow through only in FY27. Which brings us to point number 4. On volumes, they're assuming metal sales are expected to grow at a modest 2% CAGR over the next few years, because major of the expansions will come on stream only after more than 2 years. Remember, by 2030, the management is targeting 2 million tons of refined metal and 1,500 tons of silver. And finally, Jefferies forecast annual free cash flow of around 8 to around 14,000 crores, with ROEs at around 69 to around 85%. So put all this together, Jefferies, they have initiated coverage on Hindustan Zinc, and they have a target price of 660 rupees. Parag, what do you make of this one? Float is limited out here, but that tailwind is coming about with silver prices zooming and, breaking out of a range that we've seen for 45 years or thereabouts. I'll tell you what, speaking to a couple of silver experts, they said now it's not a percentage move. It'll be a multiplier mode. If that's the case, will you bet on Hindustan Zinc?
No. I am a contra investor, Nigel. So I will not buy into this momentum after the stock has rallied 13% in a week. And after that, entire world and I would say everybody is bullish on silver. I will never buy that. I will buy Hindustan Lever where everybody has given up. Everybody has thrown in the towel.
Okay. But so Hindustan Unilever is something that you're bullish on, is it? You're a contra investor there.
Yeah, contra investor. I have 3.5% weight and always looking to increase on any dip.
Okay, I thought Parag was being, I said HUL just for he was naming the stock Hindustan just for the sake of it, but he actually had HUL.
That's why I remembered.
Okay. No, it happened. But take your point there, Parag, absolutely. Just make sense to kind of be a little careful when you've got everyone which is already on one side of the trade in that sense. The other bit which I want to talk about, Parag, is names like Asian Paints. Again, I mean, taking a leaf out of your HUL kind of idea, kind of unloved sector still, although it's come back up. It came back 2 weeks ago. Last week was down almost 10%. Any thoughts on the paint space?
So we, like today I'm speaking about Lever, we bought Asian Paints at around 2,240. But we booked out actually, and we have already sold it. But I would love to buy this kind of blue chip great companies when nobody wants to look at them. So that is why Lever comes into my list first today.
Okay, all right. Let's turn the lens then to Lenskart. And let's run our viewers first what Morgan Stanley has to say. They believe at current levels, the stock is fairly valued. They have, I think they have an equal weight on the stock with a target price of around 445 rupees. They note that the company is a distinctive play on shifting lifestyle dynamics. The company is largely insulated from macro headwinds. And also they believe that it has elements to be the Accelero Luxottica from India. That's one of the big brands in Europe. They believe that it has the potential to go to that sort of heights. For the time being, the stock at around 405 rupees. Parag, what's the view out here? One of the most hyped IPO of 2025. Everyone had a view. To be fair, the stock actually is around its IPO price itself after correcting 10% on the listing day, though the float is very limited. Interested or not?
No, basically, I am looking at this company amongst the latest IPOs. I find this company interesting. It actually adds value to the customer. It makes cash profits at least. This quarter, we saw 100 crore PAT and significant amount of depreciation. So cash profit is there. But I would agree with Morgan Stanley that it is fairly valued. I would like it to buy at a lower price. I have not yet bought it, but it is one of the IPOs which one of the companies which is tech enabled and it really provides value to the customer. So something on my list, but yet I have not acted on it.
Parag, hi, morning. Speaking of IPOs, what about ICICI Pru AMC? Did you like the price at which they're coming or no?
Yeah. So 6-month profit is 1,600 crore. So you can say they can make a profit of around 3,000 crore. IPO valuation is 1,06,000 crore. So it is at 35 P against 46 times for HDFC AMC. And I have worked, so I will be biased. I have worked with ICICI Pru AMC for 6 years. Mr. Naren is my mentor and guru. So I would say that it's a fantastic IPO. Instead of applying to unknown names in IPOs, investors should apply here. Definitely, it's a proven, time-tested management and AMC. And they will take care of your money, whether when you invest in them directly in mutual funds or their stock, in my view.
So that's a thumbs up from you. Two more stocks which have been in the news all through last week. So just quickly running them past you. One is Siemens. Siemens sounded a little cautious in their investor call on their, on the pickup in capex, etc. Though they're saying their SI business, smart infra, that's doing really well. What did you think? The stock fell on Friday. What did you make of it?
I feel that all these cap goods companies, selectively, of course, there may be some who are available at attractive valuations, but I think the multiples are too stretched. See, this is not a thing which you consume day to day, right? It is. So you have to take a very big call on capex, and capex right now, this year government's focus is clearly on increasing the disposable income for middle class. GST cut, interest rate cuts, and income tax slab increase all tells you one story, that government's focus is consumption this time, and through consumption they want to revive the private sector capex cycle. Up till now, last 10 years, government has done a front loading of the growth by doing capex. Now they want private sector to kick in, and that is what they are driving by increasing the consumption, disposable income. So I would believe in that theme and go in consumption stocks. That is my personal view. Of course, at some point, definitely capex cycle will come back. But right now, my portfolio is more tilted towards consumption.
More tilted towards consumption. Okay. Since I was going to ask you about Keynes, but since you said consumption, let me ask you about the big QSR deal that everyone's been speaking of, and let's see when we get details. This Sapphire and Devyani. Over the weekend we had news that the gentlemen who are running the Costa Coffee business and the Vango business, they're stepping down. So maybe it's a precursor to, that larger amalgamation. And this has been on for months now. Do you like the QSR space? How do you look at these two companies? Any thoughts?
See, in QSR space, I've been tracking the numbers. Jubilant Food is showing good numbers. But apart from that, I have not seen interesting numbers from this space, but I think it will come out gradually. So it's a space to watch out for. I have not acted on it yet, but it's a space to watch out for.
What about Restaurant Brands Asia? Any view out there? That deal as well is apparently in the works and widely reported, I think, for a while. And we as well had a recent update just a week or so, I think a couple of weeks or so ago, and the stock has done well from there.
Yeah, so because the stock was beaten completely down, right? I think last time some blocks happened at around 100 rupees. Now it is 67. So I would say that the stock is completely beaten down. If somebody can take care of the balance sheet and reduce leverage, then of course it is very attractive at this price. But of course, disclaimer, I have not bought it yet.
Okay. All right, Parag, we'll leave it on that note for this morning. Thanks so much for that quick fire. We managed to pack in lots of stocks this morning. Thank you for that. You have a good day. We need to take a quick break. Come back on the other side. We'll have the pre-opening rates. And also we get into a conversation on the telecom space. Gaurav Malhotra of Axis Capital is joining in. There are some fresh reports around VI and what the next steps could be from the government. We'll address that. And then our technical experts, Sudarshan Sukhani and Mitesh Thakkar, with some of the trading calls of the day. Welcome back. So we are all set for the pre-open the next minute or so. And let's see, because the implied open has been telling us it's going to be a cautious start. We'll probably start 90 points lower. There you go, 80 points lower. We'll have the actual rates, pre-open rates coming in. Let's, in the meantime, get to our technical experts. Sudarshan Sukhani and Mitesh Thakkar are with us. Gentlemen, morning to both of you. So it's the same situation, right? The market seems to be getting sluggish. It's stopping out every time we hit this 26,000, 26,100 zone. So, Sudarshan, what would your trading approach be with respect to the indices today?
Good morning. Actually, it's not a good morning. I'm in Delhi and around 500 plus AQI. For those who don't live here, good morning. Now, markets are in an uncertain position. You know, we have gone into a trading range and we are refusing to come out of it. 25,900 on the lower side and roughly 26,200 on the upper side. This market will resolve itself at some point of time and move out of this range. That will be the real direction of this market. Inside this range, it's going to be intraday trading on the best kind of range. Stay away. So today's view is that so far as 25,900 is being defended by the bulls, nothing to do. If it is broken, take short positions.
Okay. Take short positions. Got that. All right, Sudarshan, and hope things get better on this AQI front. We are just getting a bit of a demo here in Mumbai. It's extremely painful. Anyway, let's move on with market action. Mitesh, what about you? Going to get a dip this morning. Last 2 days have been good. Buy the dip or stay away?
Actually, difficult to understand if you want to buy this dip. Good morning, because we are still in the middle of that range of 26,300 on the upside to about 25,800, 700 on the downside. And therefore, when you get a gap up or gap down in the middle of the range, difficult to decide which way the market is heading. So I, for the time being, ignore the index trades and focus on stock sales. But yeah, buying closer to lower end of the range, which is 25,800 is what people should look at and take profits around 26,200, 250 levels, and a breakout beyond 26,300, obviously. That's the longer term breakout.
Okay, got that. What about individual stock, Mitesh? What's on your radar?
On the stock side, I have 2 buys and 2 sells. On the buying side, on the buying side is ICICI Pru with a stop at 636 for targets of 670. And a strong reversal was seen on the charts of Dalmia Bharat. So that's a buy on a mild dip, say around 10, 20 points, 2060, 2050 could be a good entry point. Keep a stop below 2029, look for targets of 2125. And on the selling side is CAMS with a stop at 768 for targets of 730, and ITC, that's a sell with a stop at 404 for targets of 392.
iPru is one of Mitesh's picks. By the way, all of the insurance stocks, life and non-life, they've opened out with positive gains. And some of the smaller names like Go Digit, early in the pre-open session, are really flying high. Go Digit is going places. It's up 7-8% right now. That's iPru, SBI Life, HDFC Life. Most of the life insurance companies are up and about. Let's pull up Star Health as well, the standalone health insurers, because, of course, it's 100% FDI that this new bill is promising to allow, raising the cap from 74% earlier. Okay, Sudarshan, let's come to your stocks for the day as well. Which ones are you going with?
It's almost the same, 2 buys and 2 sells. And one of them is common. Dalmia Bharat is a buy for me also with a stop under 2035. Delivery is a buy. You were talking about consumer-oriented products. So maybe buy with a stop under 405. I have 2 intraday shorts. GAIL, which has a miserable chart. An intraday short with a stop above 175. And Bharat Dynamics, another chart, if you see it, falling relentlessly day after day. So that's an intraday short with a stop above 1440.
Okay. I just want to make a quick mention. Thanks very much, both of you, and we'll chat again. Sudarshan, Mitesh, Rupee, by the way, has made a new low of 90.56 against the USD. So remember, over Wednesday and Thursday, the dollar index fell about 1%, and that's against a basket of currencies. And those were essentially the days where the rupee also made a new low. we had a very senior person on the trading side from Bank of America who basically said that it's a couple of things: interest rate differentials, to his mind, between India and the US, that's, of course, unless the Fed starts to cut and the rate differential narrows, there's going to be a persistent problem. And of course, the second bit was the India-US deal. He said, well, important for sentiment more than anything else, but important nevertheless. On your screen, 90.55 as we start this morning. It's not a big one. We've had very large moves in the last 1.5 months or so, but incrementally, this marks itself as a fresh low on the currency.
Absolutely. And let's see if it pulls back, because on Friday it hit these lows and then it pulled back a little bit to about 90.40 thereabouts. We'll see how this plays out. By the way, the problem with the Nifty right now, because that rate is looking so warped, is because of just one stock that's stuck, and that's HDFC Bank. It's stuck at 5% lower. Very unlikely that we get that sort of an open, but we'll see. Because of this, the overall Nifty rate is suggesting a 300-point downtick. Let's just give it another couple of minutes. The other one to focus on would be Vodafone Idea for sure. Look at what Vodafone is doing. It's zooming ahead in the pre-open. It's crossed that 12 rupee mark now. Okay, now it's cooled off a little bit. When it opened out, it was trading above 12 rupees. And this is one of the focal points that we want to discuss with our next guest. There are reports that are suggesting that the government could look at the next steps for Vodafone Idea, and these steps could include giving the company an interest-free moratorium period of about 4 to 5 years for the payment of the AGR dues. Let's actually go across to Gaurav Malhotra from Axis Capital to talk about this and, of course, other developments in telecom. Gaurav, morning. So Vodafone Idea always gives us the headlines, right? Now, and we're independently trying to assert this and confirm this, but the reports that are indicating this kind of a moratorium, 4 to 5 years, no payments needed, no interest, is just a complete stop on that massive payout of 83,000 crores. Does it give enough of a lifeline for Vodafone Idea to go ahead, raise debt funds, and basically get the business on track?
Yeah, see, the way to think about it is that there are two major items which are outflows, which we need to think from Vodafone's perspective. One is the AGR, and the second is the spectrum dues, right? So in the AGR, we actually forget that there is a spectrum amount of almost 1,20,000 crores also sitting. Now, if this were to happen, what we are reading in the news that if there's a 4-5 year moratorium, it is sort of half and it will be interest free. Then the way to think about it is that from this year, Idea had to pay 16,000 crores just on a yearly basis, just from AGR annual. Now that will then obviously not be there, and that gets pushed to say 20, 30, 31. From a spectrum, at least in the next couple of years, the amounts are not very significant. It's like 3,000 crores this year, 7,000 crores next year. But say come the year after, the spectrum amounts due will be like 15,000 crores, and then it goes to 27,000 crores. So obviously this helps, right? At least the next 2-3 years, it really helps on the cash flow situation. And then the key variable which we have to sort of understand is what happens to the EBITDA, right? Because end of the day, the funding gap will be a function of how much EBITDA gets generated. So today, the pre-Ind AS EBITDA is around 9,000 crores. Now, if you have to pay, say, 15,000 crores 3 years hence, for spectrum, right? Then obviously the 9,000 will have to sort of move up substantially. So we'll have to see, but definitely if this were to happen, then at least it gives you some breathing space for the next say few years.
So Gaurav, lots of numbers. Let me just reiterate for clarity. What you're saying is that if the moratorium comes in, then on the AGR front, there's huge relief. Vodafone doesn't have to pay the 16,000 odd crores every year. And spectrum, you're saying that though the overall sum is very large, over 1 lakh crores, it's staggered. So it's only about 3,000 crores every year, which is not much of a deal.
3,000 crores this year, which goes to 7, which goes to 15, and this goes to 27,000. So that number sort of keeps moving up.
Okay. But it is manageable is what you're saying. The spectrum payouts are still manageable as long as the moratorium comes in.
EBITDA sort of moves up substantially from right now.
Okay.
I heard an interesting analogy. While this was, I don't know, Gaurav, you can hear me, that this entire Indigo crisis was going on, right? Monopoly and not too many players in the system. And someone said, well, it's the same thing if anything, the Indigo crisis should precipitate a solution for Vodafone. Because of
what's the link? What? Indigo, Vodafone?
Yeah, because in telecom as well, you've got few players.
Yeah.
Right.
Yeah.
And it's a vitally important sector, obviously. And what happens if so the government would not want concentration of market share just between two players. It would want one more strong player. So
but the government can want what it wants. Ultimately, people have to come in, set up the business, put in the capital.
The business is there. I mean, I have people in my family who is Vodafone. It's just that you got to take a view and the numbers and all, of course. But the point is, it's about relief. I mean, they've got such large and the numbers, etc. Gaurav pointed out. I don't know, Gaurav, does that make sense broadly? I mean, it's just from a more top-down kind of perspective.
The government has been talking about the fact that they don't want to duopoly in telecom, right? And it is amply clear based on all the interventions which they have taken. So it's quite evident that they don't want a two-player market, even though BSNL is there, but BSNL from a market share is just too small, right, to matter in the larger scheme of things. So they do want like a three-player private market. So like I said, from a relief perspective, this definitely gives a relief for the next few years. And then obviously beyond that, we'll have to see what happens to the EBITDA and how the company can sort of navigate that up move. For it to start making meaningful sense, say from FY29 onwards.
And beyond national good, for which obviously nobody wants monopolies or duopolies, telecom or any other sector. In this case, the government owns almost half the company. So in any case, it has a lot riding, right? It needs to perhaps see this resolve itself.
Interesting one. Now, Gaurav, simple fact, that a lot of viewers will want to understand. Talking about a potential relief, now the stock has crossed that FPO price of around 11 rupees. So technically, that's in favor. And there's probably a price increase as well that's on the cards. Are you factoring in a price increase? There was some murmur that this is likely to come about in December. So run us through that. And what do? 11 rupees, 80 paise. Would you, say that maybe risk reward is in favor? Or no, you would say stay away?
See, the tariff hikes are being assumed across all the operators in their estimates, whether it is Jio, Bharti or Vodafone. So nothing, so it's not as if this tariff hike needs to come for the numbers to sort of be upgraded. The tariff hike has been delayed, but I think so it's just a matter of time. Our house view has been that somewhere between December to June, December of this year to June of next year is one we should expect some tariff hike of say around 10-12%. See, from a stock, Vodafone stock perspective, it's a little tricky because we'll have to see what is the actual relief. Assume that this relief is what we are talking about, say 5 years, halving of the spectrum amount, the AGR amount, right? So that is actually 3 to 4 rupees, up from a share price perspective. Now, our target price is around 9, so then 9 becomes a 12 and a half. So from our perspective, it really doesn't swing the needle as much. Equally importantly, in Vodafone, we also need to see what happens to the base business, how much capex is put in, and what happens to the subscriber and ARPU trends over there.
Okay, so 10 to 12% tariff hike over the next 6 months. And if Vodafone Idea gets this sort of a reprieve or a moratorium on AGR payments next couple of years, then perhaps it really has a fighting chance to set its house in order. Got that, Gaurav. Great conversations always. Thank you for the perspective, and you have a good day. We look forward to connecting again soon. Well, with that, let's get back to the screens and let's see if this pre-open session has settled. And it finally has, and the Nifty is down about 116 points in the pre-open. Now back to our technical experts then. Sudarshan, what's the stock call you're going with?
Well, it's delivery. Buy with a stop under 405.
All right. And Mitesh, what about you?
Buy on ICICI Pru for targets of around 670.
Okay. All right, gentlemen. Got that. Thanks very much. Let's just see what's going on in the pre-open and also in terms of some of the stocks which were in news. KC International, by the way, has won an order. It's a little over 1,000 crores. Stocks reacting well, 3.5% up. TBO Tech had an analyst call, as what Riya just told us. And that analyst call, whatever they've said over there in terms of business expansion, the market seems to be liking it. And of course, there's Vodafone Idea, which is up and about. With that, let's look at Federal Bank because there is a positive brokerage report on Federal Bank as well today. Gaurav's joining in. Gaurav, welcome back. Congratulations. It's the new side of life. Now you join in as a happily married, boy or man, should I say. Congratulations. And tell us more about Federal Bank.
Well, thank you so much. Now, moving to Federal Bank, if you look at UBS, they are actually being bullish on Federal Bank. They have increased the target price to 310 versus what it was at 250. And their argument here is that they see improvement in the operating side of the bank, and that is the reason why they are being bullish about it. For credit costs, they are expecting credit costs to remain low. When it comes to loan book growth and net interest margins, now they are expecting it to remain subdued, at least in the near term. But what is another key thing to highlight is that if you look at the valuation, now they have given a valuation, they value Federal Bank at 1.5 times price to book if we compare it at FY27. Now they believe that this is similar to IDFC First Bank, but if you look at Federal Bank, they have better ROE profile, and that is the reason they also believe that the loan book growth gap that we are seeing right now will get narrowed in the medium term. Apart from that, they are now raising their medium-term target almost by 5 to 9% in terms of EPS, and that is the reason why they have increased their target price to 310. And given the bullish call, we will definitely watch on how it works for Federal Bank in a day-to-day.
All right, Gaurav, good to have you back. Congratulations. Wishing you and the BB a very, very happy married life. And you know who's the boss, brother. Any tips you require, please reach out. Been there for 11 years, so I know how it is. We'll chat, once I'm out from the studio. But all the best to you and the lovely lady.
Thanks.
Okay, all right, let's do a quick recap then of all the top stocks we covered earlier this morning. Stocks in focus include Interglobe Aviation, we have Oro Pharma, Biocon, Keynes Technology, Usha Martin, Amber Enterprises, TBO Tech, NLC India, Godavari Power, as well as Dr. Reddy's. So those are all the top stocks that we're looking at. But I think, Prashant, we just got a few seconds before we get to market open.
Oh, absolutely. And, let's keep it with the price. We'll have the first rate start to come up on the Nifty Bank, etc. And we'll take it from there so in terms of individual names. So what do we have? First rates. 100 points lower on the Nifty, 376 points lower on the sensex. So 25,930, 84,891. And there you go. Off we go. A third lower on the Nifty. And I think the Nifty Bank finding a price, 59,300 or so, I think is where we are starting at. 59,270, 250, 240, 0.25% lower on the Nifty and the Nifty Bank both. Mid-cap index is down a third. The small-cap index, I think, is starting slightly lower as well. So those are initial rates at this point in time. A third now lower on the Nifty. So fast changing, fast moving, just finding, I guess, a level. But it's about 85, 90 points lower at this point in time. I think you got bulk of, everything which is opening is in the red and about 5 or 6 names are in the green. Trent is down on one end, Cipla, Dr. Reddy's at the others. Indigo is starting higher and it's the biggest gainer at this point. I don't know if it's a big gain, but on the Nifty, it's the biggest gainer at this stage. That's a Nifty heat map up on your screen. 90 points lower. Surabhi.
Okay, let's take a look at, what's moving up and down on the Nifty. On the downside, you've got Trent, 1% lower. M&M is seeing some profit taking, 1% lower. Dr. Reddy's and HDFC Life. There is NTPC, there's JSW Steel. So basically, there's no sectoral trend. It's completely mixed. Nestle is slightly lower. Eicher Motors is slightly lower. Hard to pick out any kind of sectoral sense in this. On the upside, not too many stocks at all, actually. It's an overwhelming down screen, at least for now. There are only 2 green ticks really on the upside. One is Interglobe Aviation. That stock's up about, 17 rupees this morning. And then there is Shriram Finance that's managing to keep its head above water, but only very barely so. Overall, the Nifty is down. It is that gap down open, 100 points that has been delivered. Now we need to see if the bulls can once again come back in and buy this dip, taking the Nifty up to 26,000. But for now, 90 lower.
Well, that's right. There should be, a few stocks that are in focus. Geojit, I think we should get that stock up for you in the screen. There are close to around 3 crore shares that have got traded out there. So there's a very, very large trade that's taken place on Geojit. I think we should get that one up for you on the screen. One, the volume's very high because massive volume actually in terms of a change. We'll try to get you further details on that. Stock a little bit lower. Another one from the broader markets that's low is Reflex. That's down close to around 10%. I think there was an IT raid out there. Stock was down even in Friday's trading session. And today, it's seen another downtick. Actually, they've conducted, IT Income Tax Department has conducted a survey at the company's office from December 9 to around 13. So that explains why that stock is under some pressure. Pull up Brigade Enterprises as well. The IT department conducted a survey out there as well between December 9th as well as 13th across its premises. So I think we should get that stock up for you on the screen. Besides both these two names, Astra Micro, they're bagged 120 crore order. So I think that stock, in fact, has opened up in the green. Some mild green is what we're seeing on that particular name. Let's get it up for you on the screen. Coffee Day, volumes, not very high, but that stock is up close to around 15%. And I believe Surbi was watching a movie over the weekend, and PVR, in fact, is in focus. A good bounce is what we're seeing on that particular name. And the pipeline as well in terms of releases look pretty good. So that stock up 5% as we speak.
You know what? And the theatre was packed, I can tell you that much. It was house full, and it was almost next to impossible to get tickets for this latest release, Dhurandhar, anywhere, in Mumbai suburbs. So yeah, I think it was a weekend of good box office collections. PVR Inox up 4.5%.
Absolutely, and I think we'll have more rates come up for you on your screens as we kind of go along. The Nifty is now settling, finding its feet 90 points lower. It's about 1/3% lower, so giving back some of the repair that we saw over Thursday and Friday. It's I think right out. Let's just look at the market breadth as well. Too early to do that, but maybe just gives us a quick sense more than anything else at this point in time. NSE advanced decline ratio should be up on your screens in just a bit from now. What do we have? Okay, on the sensex, the NSE, it's 1,500 down and about 900 higher. On the BSE, something similar as well. So that's the picture. Krishna Sanghvi is with us, CIO Equities at Mahindra Manulife Investment Management. Krishna, great to have you with us here in the studios. Good morning. Thanks very much
thanks,
for
Prashant.
Joining us. So where are we at, Krishna? I mean, no man's land as we wrap up this year. Can't thump the table and be bullish. No reason to be bearish, I guess, as well in that sense.
Yeah, I guess no reason to be bearish is a best part. Bullish part, conceptual economy is good. We're doing good. 1 and 2 years, we get this kind of syndromes where markets are getting a little bit lackluster, more with downward bias, and that's where we need to look. Whether markets are run up too much ahead of time or not. So if you think of it. Today, the reasonable amount of thought process that, small caps are not doing as well. But if you step back a year back, maybe, it was exactly reverse. So that's a little bit, economy angle where we say that economy does well, but the leadership in markets among large, mid, small or among sectors keep on changing. Maybe you call it profit pool participation or market acceptance of those profit pool. And last is, investor behavior. In terms of what segment of markets they seem to be more attracted. Because let's face it, investor flows also drive market behavior. If too much interest in small cap or mid cap in terms of money flow, that does, create a new demand. And the last part in the markets, the way we see really is that you got, a reasonable rebalance this year vis-a-vis what, the previous 2 years has been. The mutual fund, the domestic investor appetite for stocks remaining good. This year has seen a nice rebalancing where, corporate India has basically come up to get, its own share of fresh funding, or maybe promoters or PEs and VCs have got their own share of exits. Nice rebalancing, where it was a good demand for a couple of years. This year has been, supply has caught up. So hopefully next year, let's see how best, the market respond to this both, reasonable appetite for Indian equities by domestic investors vis-a-vis the corporate supply.
Yeah, at least in the next next 15 days, at least IPO supply, IPO activity should be a little low because, it's the end of the year and normally you don't have too many large issuances, etc. opening up. But then, of course, we'll see. Next year, of course, it's a big pipeline, at least going by some of the indications, etc. out there. Krishna, just to complete that point, for viewers who are watching, is it possible we spend another 6-8 months in this kind of a phase where not very much is happening with slightly downward bias? That's not the general consensus expectation. That's why I'm asking you that.
Yeah, it's possible. So I guess let's look at, Indian market from demand supply dynamics of market. Economy, let's say broadly, we know we are more or less in that, close to 10% nominal GDP growth rate we've established well. I think let's look at markets. Okay, from a demand supply, you got Indian investors looking to buy equities. They have nice nominal income growth, savings are rising, so they have a willingness and appetite for equities both. Corporate India is in a way some sort of a perpetual supplier of equities. So you got two players balancing out: core demand from Indian investors looking to invest, core supply from Indian corporates either directly for the good of the company in terms of raising money for the growth, or possibly some sort of a promoter exits or reduction in stake, etc. So the third player in the entire dynamics really is the FII. So there will be cases wherein FII turns positive in India. So you suddenly have a nice equation of two participants looking to buy and one looking to sell. There are cases where FIIs look to sell, and there you have two sellers and one buyer market. So if I look from that perspective, we need to evaluate how India is vis-a-vis the global, and that's where the good news starts. Where we had some sort of a dream run for a couple of years till, let's say, CY24, where Indian markets did exceptionally well vis-a-vis other emerging markets. Now we're reaching a situation in CY25, the way the year behaved. Indian markets may not have done much, let's say, but global markets, especially other emerging markets, have done pretty well. Which means, on a relative valuation perspective, again, India becomes, attractive investment option for FPIs, because unlike Indian investors who have a reasonable reasons to remain invested in India because of our own let's say capital account convertibility kind of issues, global investors have a nice ability to dissect valuations across economies, across markets, and 1 year, 18 months of underperformance makes them reasonably attractive. The way 12 months back the noise was really that India is slightly more expensive or premium valuation vis-a-vis the global emerging markets. Today, the noise is exactly, after what's happened in last 12, 18 months, we actually caught up. Might be still premium, but the gap is what, finally. So that's the advantage of financial markets. Finally, we are a nice, rebalancing of YOY, which matters.
By the way, you guys were talking about primary market, and Krishna was talking about the paper supply as well, right? Wakefit is listing today, and we know the company. Most of us have sort of either been to the store or touch and feel is there. Large part of their revenue comes in from selling mattresses, and then there is some furnishings as well that they're doing. So furniture and mattresses, guess at what price the issue is coming in terms of valuation?
Market cap they were asking for?
Yeah, the price to 70 to 80 times.
Earnings.
So, and Krishna, that's my question really, right? Because
so a good mattress is very expensive, huh?
It is. But Krishna, my point is, and kudos to the investment bankers who managed to sell these stories. Now, and kudos to the companies. I'm sure it's fabulous businesses, whether you're selling mattresses or chashma or whatever you're selling. And the backend has to be digital. You have to reach your customers through a very, very digital, effective, efficient medium, right? But does that make you a tech company? And does that justify the kind of valuations that some of these companies have been coming at? What is the investor experience going to be? And these issues have been, of course, there's a lot of selling. Even the Wakefit IPO, by the way, largely is an OFS. It's barely 300 crores coming into the company. It's existing investors exiting at these valuations. It has a separate rupee, situation that it creates. Lata was, telling us about that. But really, what are we in for? What are we talking about when we have these companies coming at 70, 80 times? And obviously with this kind of paper supply.
I think macro picture, if you look at, let's dissect some of these IPOs into components of, what value add the IPO brings. Okay, the easiest value add is they create additional market cap for India. So if you think of it, despite a lackluster year vis-a-vis last year, Indian market cap has actually risen, and market cap to GDP has further gone up. The reason primarily being around 100 odd companies which have listed and created market cap, which basically means India is, as a top down, become far more expensive than what maybe we would have been a year back from a pure market cap to GDP, which is that one of the global indicators. Now come to think of these IPOs, some of these IPOs, we call them good IPOs, where the company is raising money for its own growth. The money primarily goes into the company for its own expansion, whether it's a rollout of a store network or a physical capacity creation by way of plant, etc., or even at times improvement in working capital. Company wants to be debt free by raising money, and that's good. There are some companies, where it's more of a stake sale, and that's where you need to differentiate between some of those variables. But yeah, clearly the IPO is in a way, look at it over 10, 20 years. that's for a typical end outcome of a bull market. There is too much strong demand for equities, corporates have a nice reason to,
I just get worried when I think of my SIPs buying businesses at 70, 80 times because a lot of the IPOs have happened only thanks to domestic mutual funds and domestic institutions, right? That's how they've been sold. Well, fingers crossed, I guess, for the future.
Yeah, I guess, and somewhere just to say that worry, you might just need to adjust how much as a percentage of the portfolio those are carried, rather than getting worried with the SIP.
That's true. There might be a very small part of the retail portfolio. Absolutely.
Krishna, I'm an optimist, and I believe phases like this is a very good opportunity. In the next 15 years, my portfolio look very, very good. Because the last 18 months actually has been painful to see a flattish number on all, all the SIPs, all the mutual fund investments that I do. But I believe it's par for the course. And, in the longer run, we'll get that low double-digit returns that we are looking at on a CAGR basis. But I'm going to put a very simple question to you. To getting into 2026, what kind of expectations you have on the headline index? As you said, we've seen a bit of consolidation. But actually, consolidation may not be so bad. We are a geopolitical risk. We didn't have earnings. We had a slowdown in the economy. And we didn't have a trade deal till now. And yet we're flat, which isn't such a bad outcome. So what's the expectation on the headline index, point number one? And point number two, just one sector, which you're most bullish on, incremental money should go there for 2026.
So I think headline index, clearly, we are in for a growth economy. So conceptually, we are there for a rising market trend. Now the intensity, possibly that's where the third variable in the global market called FIIs or FPIs in our case possibly matters, because they are the people who want to normalize or neutralize valuation differences across geographies. And so that gives some hope that after what's happened to Indian markets in the last 12-15 months, including partly the currency makes again India slightly more attractive because we depreciated. So I think fair to assume that we have a nice probability of FIs coming back to India, and we need that little bit restoring of balance, because as I mentioned, look at market from a three-player industry: core buyer, Indian investors; core supplier, Indian corporates, and the swing or the delta comes from. So I'll possibly go with that.
So positive bias on the headline index, and hopefully the FIs things look attractive enough for them to come back after the kind of selling that they've done. So we got that out of the way on the headline index. Are the individuals, that one sector that you believe is giving good potential?
So I think India, let's say the core story can still remain consumption.
Okay.
Let's look at last 18 months in a collective period. Government has done reasonable things to increase the post-tax income for people. They've done reasonable things to reduce the cost of products by way of reducing GST.
Yes.
So that piece has, let's say, established. So what possibly I'll say, consumption is a nice overall subset, whether it's look at auto, whether you look at retail, look at staples, and a combination of is all.
So you would say discretionary as well as staples, both of them?
It'll be a combination, because that's where the difference is. How does market appreciate those changes is a function of valuation multiple, not really the earning growth. So if I look at economy, the earning growth is likely to come more into consumption space. And partly in the entire piece, even financial services are in a way consumption, because more post-tax money with investors typically means, with consumers means they can be investors also. So that's the piece, I think,
Consumption, got it. I think earlier this year you had also spoken about metals, and in various conversations that we've had. And actually that sector has done well. Yep. It's not for the faint-hearted, but it's more than valuations, it's momentum. It has enough momentum in 2026 as well?
No, I think metals, let's look at India as a core story on metals. Okay, we have a situation where we are going for manufacturing in India as a core concept. Now, if manufacturing is a long-term story, we need the back end to manufacturing, which means metals is one of the core products which, it's very difficult to believe that we will import metals but end up, manufacturing in India, because then it doesn't really create that Atmanirbhar kind of concept. So the idea is Indian metal companies are likely to grow in line with the GDP. Even if you look at last 25 years, India steel has grown at a CAGR of more than 7%.
Correct.
So we're looking at something similar. Now, only challenge in metals is because the companies take 4 and 5 years to come with a plant. The cyclicality possibly plays out, because they're investing for a plant which is likely to come 5 years down the line. But markets, at the exactly same point you mentioned, you said investing for 15 years, but end up reviewing in 18 months. So that challenge, partly comes on some of these corporates. So the volatility of the sector from a news flow and And the stock price perspective can be there. But I think from a core thought process, a lot of these Indian metal companies are likely to have, reasonably high volume growth over next 3-5 years. 3 top investment ideas for 2026.
Stocks.
Come on. I don't know if you can give us stocks, but if not stocks, thematically, 3 money-making ideas for 2026 in the equity market. So one is Indian equities. No, that is a given. That is a subset that I've already outlined. Yeah. Within that, 3 themes. Yeah, I think consumption. Clearly. Okay. Maybe second can be metals. Metals. Okay. And third is we need to possibly be ready for some sort of upside to outside India-based companies where, last 1 year has been pretty weak on news flow, on maybe global economy, maybe tariff-related worries, and we see some of the exporters. Yeah, something like that. Yeah, that's right. Export. Basically, anybody earning income from outside India, they have a nice rally because even rupee is supportive for them. Yeah. All we need is some news flow positive either on trade deals or, True, and that has to happen at some point or the other. Right. It should happen. Krishna, thank you so much for joining us. Great to have that perspective from you. By the way, since we're talking exporters, look at the rupee right now. There is absolutely no stopping the decline. I mean, now we're looking at a level of 90.62. So it's just breezing past levels. And this is what I remember when we spoke with Anindya of Kotak last week. This is what he was also. I mean, a lot of experts have been saying that now that the RBI is not defending any level, it's just a race to 91. I mean, it's a one-way bet. Importers have been buying more and more dollars. And it's just, it seems to be a one-way street on the currency. It's already down 0.25%. But early in the morning, I don't know, maybe let's see if we have some sort of intervention as the day progresses. As the market opened, I just highlighted one stock, which is Geojit. A massive volume took place out there. The stock, I think, was at 68 rupees. I last checked, it was 73 rupees. So there's 15% equity that changed hands on Geojit. And there's a big uptick, what we're seeing out there. Volume's very, very large. We'll try to get you further details, but that's one stock that's on the radar. The other one is Hindustan Zinc. And, we had a note coming in from Jefferies today. And they have gone ahead and they have initiated coverage on the stock with a target price of 660 rupees. Their estimates that they're factoring in with regard to EPS is 22 and 29% over the next 2 years. That's 26 as well as 27. In 28, they're working with, a single-digit growth of close to around 7%. Remember, they're much higher in comparison to consensus estimates on the street by around 9 to around 31%. So their estimates are much higher. The stock, they point out, is trading at around 9.2 times. That's much higher than the long-term average of around 7.3 times. But they believe is justified because of the higher share that it has with regard to silver in the EBIT. On the pricing assumptions, actually, they are 4% lower on their pricing assumption of zinc in comparison to the spot. And on silver, they're 3 to 10% lower in comparison to spot. So pricing as well, they are factoring in softer prices from here on. And in spite of that, they're expecting a big EPS growth. On the sales volume, well, they're saying that will grow only by around 2% over the next few years because expansions will come on stream only by the second quarter of FY29. But they go on to note that by 2030, they have a very, very ambitious target out there. They're expecting strong cash flows in the vicinity, free cash flow of around 8,000 to around 14,800 crores per year over the next few years. That's a little higher than the 10,000 crores that we saw in the last few years. But on the ROE, they're factoring in much better numbers of 70 to around 85%. So put all this together, silver's been twinkling, and Jefferies believes Hindustan Zinc is well placed, even post the big run that we've seen in the recent past. Just one more point, Surbi. In the middle of this year, that's in June 2025, we here at CNBC-TV18 had put out this point with regard to the rise that we've seen in gold prices, and silver could potentially catch up. Yeah. At that point of time, silver was up only 15%, while gold was up more than 35-40%. And actually from there on, it's played out perfectly because silver has rallied more than 60% from there, while gold is up around 15-20%. So we had pointed that out. That could be a possibility. Happy that it's played out. Absolutely. And that was, good foresight to put that out because look at the absolutely scintillating rally on both gold and silver this year. But for now, it's back to equities and back to corporates. BEML is the company that we are putting the spotlight on this morning. Now, the stock is down about 15 to 18% over the last 1 year. Q2 numbers of the company were below estimates. However, BEML has said in the past that it's expecting full year revenues to grow between 15 to 20% for the current year, FY26. So will that really happen? Well, let's discuss this and more with Mr. Shantanu Roy, Chairman and Managing Director of BEML. Mr. Roy, thank you for joining in. First of all, season's greetings to you. I'm hoping you're getting set to wind down the year in a good way. But, if we talk about the performance, and I don't think we've had a very detailed conversation after the second quarter. So let's just go over. Now, the issue is, I think, execution. There's absolutely no problem with the order inflow for BEML
Every month, every quarter, we keep looking at more and more order wins. But the execution has been lacking, which is why year on year, Q2, there was hardly any growth. Margins are flat. So will you be able to achieve this objective of 15 to 20% top line growth and 150 basis points margin improvement, which is what you had highlighted for the full year? Will that happen?
Hi, good morning. You very rightly pointed out, that order inflow is not a problem. Now let us look at, before I move on to the growth in terms of the top line and the margins. Let us analyze and understand how the capital goods sector, which has certain elements of gestation period, how it works. So order inflow, absolutely, we are bang on target. And I expect in the next 3-4 months also, we will have some good order inflows. And we should be ending the year 31st March 2026 on a pretty decent number as far as order book is concerned.
Can you give us some numbers there as well? Because that's the best part, right? Because your order wins are so good across, public infrastructure, transportation, and of course, defense. So let's get the good part out of the way. Then we'll come to the challenging part. So you're likely to end this year with the order book roundabout where?
It should be 20,000 plus.
20,000 crores of an order book, end of FY26. Fantastic, sir. So now let's come to the execution. Why is not execution picking up?
Execution is picking up. It's not correct to say that execution is not picking up. Execution is picking up. Now let us look at how the capital goods industry operates. Especially now we have 3 diverse verticals. Where mining and construction is a very fast turnaround vertical, whereas the rail metro and the defense, it has a longer gestation period. When we started the year, we had 14,610 crores of orders, to be precise. Currently, if we look at a 20% growth margin, that is what we are aspiring for, we have the orders except a small chunk of orders, maybe 200 crores, which we expect from the mining construction and which will be executed in the current year. So for executing, for achieving the 20% growth in top line, we have all the orders in place. And it is another good thing is that they are all executable in the current financial year, especially in the rail and metro and in defense. As far as mining is concerned, in the balance period, we expect at least 1,000 crores of order inflow, out of which some 200 crores is required for execution in the current financial year for us to achieve the 20% top line. Now, why it has been flat? There are some reasons. The rail and metro orders that we received and which are now cleared for execution in the current financial year, up to the first half, that is the first 2 quarters, there were challenges in supply chain. The Bangalore Metro, which we rolled out 4-5 days back, we could have done it in the month of September itself, but some of the key supply chain partners, they could not deliver because of certain rejections. Same happened with the supply chain for defense as well. I've been already communicating that indigenizing the key critical components and aggregates, it is taking time to stabilize. And now we are at that stage where almost 90% stabilization has happened. So that's the reason we are quite upbeat that in defense, we will be able to execute our target, what we have planned this year.
So, sir, your supply chain, so just to understand this, the supply chain issues that you have highlighted in the past, you're saying that in the second half, most of them are resolved. Are you on track for 20% revenue growth this year?
We should be, yes.
Okay.
And margin improvement of 150 basis points, right?
If we have a 20% growth in top line, then margin improvement, 150 basis points definitely is going to happen. And now, as far as the supply chain is concerned, we have some critical component suppliers. As I said, 90% stabilization has happened. And in the next 2 to 3 months, it will be, we will reach 100% stabilization. And 25-26 will be the year when our supply chain would have stabilized. As far as the metro is concerned, this month itself, we are also planning to roll out the second metro of the for the Bangalore project, and we will be completing the 63rd train in the current financial year for the Mumbai, and we also expect to at least deliver 6 to 7 more trains for the Bangalore metro in the current financial year. Okay. Again, we could have done more had the supply chain supported us in the metro. In the metro, the supply chain is still to for the Bangalore project, the supply chain is still to stabilize. Otherwise, we could have done maybe at least 4 or 5 more trains in the current financial year. Okay. So, the supply chain challenges will always be there. Okay. And we are on target to resolve those issues. Right. And that is one of the major bottlenecks for the execution, if I may say that. Otherwise, the company's focus is fully on execution. But another thing we must look into is, what is a normal execution? Normal execution is around 30% of the total order book, generally as a thumb rule. So if we end the year at 20,000 plus, so 25, 26 26, 27 should see a further growth. That's why we are also focusing on the order book pipeline. Okay. Because most of our projects, the big projects are coming from the rail and metro and from the defense, and which have a gestation period of at least 2 years. Yes. So we have to build an order book pipeline so that there is a sustained growth.
Got it. Just to confirm that point, but you're confident as of now that 20% revenue growth will be achieved this year, right, sir? Because you said that the margin improvement will be possible if there is 20% growth. So is there a risk to that 20% growth, or you're pretty confident?
We are pretty confident.
Good.
And,
okay.
The third quarter should be much better.
Got it. All right.
We are nearing the end of the third quarter, so it should be much better.
Got it. All right. So good to hear.
It should give an indication.
Okay. Good to hear, sir. So we're bracing for a better showing in quarter 3, and you're confident about the year. Since you spoke about railway, I just wanted to ask you, what's the update on the Mumbai Railway Vikas Corporation tender? What kind of revenue, profitability estimates you're expecting? I ask you this because the total contract value, I believe, has been reduced to around 21,000 crores. Early expectations will be around 30,000 crores. So what are the expectations for BEML?
No, the contract value has not been reduced.
It's not been reduced. What is it, sir?
It is still 2,856 cars, that is 238 rakes. And the 21,000 crore that you're talking about is the car price, right? And there is a 35-year maintenance also. So when we talk about the total order book, it is, as a thumb rule, the car price into 2.04 a factor, yes. We can use a 2.04 factor. So that is a pretty big order. As far as margins are concerned, you see that the tender is already out. It's a competitive bidding, and there are a lot of competitors. So on the margin estimates, it will not be correct on my part, to talk about the margin estimates at this stage.
So broadly speaking...
So pricing is a strategy, cost is a reality.
That cost is a reality indeed. So broadly speaking, this order book, our colleague Ria, who tracks the company very carefully, she points out that I think earlier you had indicated that your order book could actually be even higher than 20,000. It could be maybe 22 to 23,000 crores. So I don't know if that's a bit of a scale down. And also just give us a breakup. As you end the year, how much of this order book is defense? How much is going to be, transportation? What will be the nature of this order book as you look at the next year?
If I look at the current order book, it is 65% rail and metro, 30% defense, 5% mining. But again, mining is not very important to have a residual order book. And if we end the year at 20,000 plus, I can see it will be around 70%, more than 70% will be rail and metro. That is a mobility and transportation. Around 25% will be defense and 5% will be mining.
Okay.
Okay, all right. Thank you very much, sir. Great speaking with you, and more questions later, perhaps in the new year. All the best of luck, sir. Appreciate it.
Thank you very much. Have a wonderful new year.
To you too, and your team as well. Thank you very much. We'll take a quick commercial break here. We come back with insurance very much in the focus on the other side. We have the former IRDAI members, Thomas Devasia and Nilesh Sathe join in. Remember, the cabinet has cleared the insurance amendment bill. And most likely, now the bill goes to Parliament. Likely today, we're still picking up, or maybe tomorrow. But now that's the next sort of course of action. We talked to both our guests on the other side on what this will mean for the sector and individual players as well. Stay tuned. Welcome back. This is Corporate Radar. Markets, of course, are a bit under pressure, about 0.4% lower. 100 points down is what you have. Well, the Cabinet has approved the Insurance Amendment Bill. It allows 100% foreign direct investment into the insurance space from the current 49%. The new legislation also aims to give more teeth to the insurance regulator, that is IRDAI. We have Thomas Devasia, former member, non-life IRDAI, Nilesh Sathe, former member, life at IRDAI. So we've got both sides covered. Gentlemen, great to have both of you here. Thank you very much for joining us. Prashant this side. Mr. Sathe, let me start by asking you about not what has happened, but what has not happened. So apparently, the composite license proposal is not part of the bill, and neither is the open architecture part of the bill. So composite is, essentially allowing life companies to start non-life business and vice versa. And open architecture, of course, is allowing agents to sell, other policies as well, not just one life and one general, as it is the case right now. So both apparently are not part of the bill. So just wanted your thoughts there, Mr. Sathe.
Yeah, I think some more discussion has to go into it because there are a lot of opposition on open architecture, especially by LIC. Even SBI Life was not in favor of open architecture. So they need to be convinced. There needs to have more discussion on the subject before it is being introduced, because what way it is going to impact business of LIC. Mainly, LIC follow-on public offer is likely to be there. And open architecture should not impact their share price. That may be the thinking of government. So this is what, in my view, probably that is the reason why it has not been introduced in this bill. But maybe today or tomorrow it will come. As we have seen in case of mutual fund, the IFAs can sell mutual funds of any company. Same thing is likely to happen here, and nothing wrong in that. But then let us wait and see, because government may have some apprehensions in introducing the open architecture at this stage.
The company most impacted, of course, is going to be LIC, and perhaps a lot of opposition is the government company as well at the end of the day, in that sense. But you're saying, well, not today, but eventually it's going to come. It has to happen. The other bit is this composite license. What about that, Mr. Sathe?
Composite license till the end was what I understood was on the paper, but I am not quite sure why it has not come finally in the bill. I don't have any idea on that. But again, government might have thought that it may involve difficulty in implementation of it, because one company doing 3 lines of business, 3 separate sets of accounts may create some problem. Probably the IFRS and the risk-based capital that is likely to be implemented now, they may have thought that implementing it at this stage probably may disturb the industry as such. This is what is my view.
Yeah. So, by the way, for our viewers, I just want to say, this is what our colleague Sapna is picking up from Delhi, that most likely the composite proposal and the open architecture proposal is not part of the bill, which is going to be, which has been cleared and it's off the table for now. So, when that bill is finally presented in Parliament today or tomorrow, as we understand it, we'll have absolute specifics and we'll be able to be absolutely certain of it. But this is what we understand as of now. So I just wanted to make that clear. Mr. Devasia, just, same question to you. Your opening thoughts, perspective on this?
Good morning, everyone. Nilesh, good morning to you too. My sense is that the government, in whatever they are planning to clear, are basically looking at what's critically needed for expansion of the sector in India. And to that way, perhaps the composite license as well as open architecture for tied agents is not seen as critical. Because if I look at it, a composite license would actually be just a accumulation of 2 lines or 3 lines of business, which have very clear financial control deviations, governance, etc. And as Nilesh also alluded to it, it may be complicated to supervise and implement. With regard to tied agents, I believe the situation on ground does not change, because especially the tied agents of LIC, who are perhaps the best distribution force in the country, are already, they are basically family businesses. And there'll be other members who are already addressing other insurers for the simple reason of getting the best products out to their clients.
Gentlemen, morning. I have a bigger fundamental question that I want to raise before both of you. The penetration of insurance in India is so abysmal that the numbers actually shocked me, even when I was searching for the latest numbers, right? Non-life penetration is 1%. And this is, I think, total premium as a percentage of GDP. That's the way it's computed. Life penetration has actually declined. It's gone down to about 3.7% from 4%. Again, latest available data. So now, I don't know if this is a capital issue, and this is for a sector that came into inception much before mutual funds, right? The first financial products that we as Indians got to know were insurance products. And then these numbers. So something or someone has to account for it. I don't know if it's a capital issue. Is it a capital issue? And if it is, then will it be sorted now that there is 100% FDI? Because to me, as a layperson, as a customer, it doesn't seem to be just a capital issue alone. There's something else that's gone wrong with such abysmally low penetration. Mr. Sathe, your thoughts on this 100% FDI?
Yeah, no, 100% FDI was actually necessary because in majority of the jurisdictions, they don't have any restriction on FDI for insurance. So that was expected, and budget announcement was also there by Honorable Finance Minister. So it was certainly going to be there. And we have steadily increased it. See, why 100% FDI? Because we have seen in the past that with less than 100% FDI, you needed to have Indian partner to start business.
Correct.
And there are many industrial houses which are already into insurance. So finding a good, reliable, long-term Indian partner probably was a bit difficult also. So now, okay, if you find it difficult, now we are allowing you 100% FDI. Now you come and start your business here.
Correct.
So that may be the...
Correct. But sir, as you said, the point is that a lot of very deep-pocketed Indian institutions have already been running the business, whether it is large banks like SBI, whether it's HDFC, whether it's LIC. So therefore, Mr. Devase, let me get your thoughts in. I don't know if really capital is the issue behind such abysmally low penetration, and what changes with 100% FDI?
Okay, so the thing is, when we look at insurance penetration ratios, they're extremely, in my personal view, superficial and also a nominal measure. For the simple reason that when insurance premiums, if you try to bifurcate them, especially on the non-life side, you'll have a huge retail sector and you'll have a huge corporate sector. Corporate sector, the premiums are also increasing because of the underlying value increase, which is also fueled by growth, organic growth and inflation. So penetration, we need to have a new measure for it to actually understand the take-up. It is a capital issue, and I would welcome 100% FDI for the simple reason this is actually a capital-intensive industry when it comes to the exposures on your portfolio, risk exposures. And there are new exposures coming up like cyber risk and all that. There is no capacity, underwriting capacity at all.
Yeah.
So capital is very much required. And I hope the FDI rules amendment will also enable insurers to actually move capital freely between themselves. That said, with regard to why insurance penetration is low, it's also reflecting the disposable income of individuals and households.
So it doesn't have to do with the industry. Gentlemen, so what I get from you is that you're both saying it doesn't have to do with the way the industry has been running itself.
No, the industry requires new capital, requires a number of players, because then only will be the real penetration push that will come.
Let me.
Income does roll.
Yeah, absolutely. I mean, I think it's one of those things, right? I mean, you make more and you want to spend on these kind of things as well. Now, the other thing is, merger of the bill allowing merger of insurance company with a non-insurance company, right? Mr. Sathe? And from a listed perspective, there is this Max Life, Max Financial Services thing, which has been discussed over the years. So just wanted your thoughts there, Mr. Sathe.
See, actually, when the Insurance Act was initially introduced, in the sense after 2000, when the sector opened, it was thought that mergers have to be between two insurance companies. Just as only two banks can merger, bank and non-bank cannot merge. There is a reverse merger now allowed, but it was not there initially. On similar lines, initially it was thought that only two insurance companies can merge, and accordingly, a couple of insurance companies have merged as well. But
Mr. Sathe, sorry, we want to, I'll just come to you. Just give me 30 seconds. I'll just make a quick mention. There are two listings on your screen. Wakefit is listed at 195 rupees per share. It's basically listed at par with the issue price. And there is Corona Remedies, which is listed with a premium of, with a big premium actually, some 30% premium on top of the issue price. So, listings continue. But as I was saying in the morning, maybe in the next 15 days or so, new issue openings, etc., perhaps a little lower, on the lower side, as we wind this year down. So Wakefit 187 and Corona Remedies about 36% higher is a super listing for that one, 1,450 rupees. So those are new listings. Mr. Sathe, go on, sir. Yes. And you're talking about the logic behind now allowing insurance merger with non-insurance companies. Go on.
Yeah. Because especially Max issue has been longing for a long time, because that for almost a decade this is going on, and finally it was thought that what is wrong in it? If reverse merger is allowed in case of banks and NBFCs, why two other than two insurance companies, one insurance company and one other than insurance company? I'm not saying non-insurance company, other than insurance company, why they cannot merge? And there was a lot of thinking going on this, and finally it has been approved, which will help actually some of the sectors to grow also, because it's not a question.
Mr. Sathe, do you have a view specifically on Max Financial? You think the road is clear now once this goes through, or are there any pending issues?
No, I think the road is clear. Actually, this has been made so that the transaction can go through.
Okay.
I think so.
Interesting. So then, the holding company discount for Max Financial should also come down.
Yes.
In that sense, right? So a positive from a share price perspective as well. I have more questions, and it's always a fascinating sector to discuss. So I hope you will come back once we have actual details. I want to emphasize once again, some of what we discussed, of course, is based off the reporting from our colleague in Delhi. And once the bill is cleared by the Parliament, pushed through, we'll have the actuals, and we will sort of, invite both of you and other experts, industry experts as well, to talk about this. Thank you very much, gentlemen, for joining us here on CNBC-TV18. 90 points lower, 25,960 is where we are at. What we'll do is we'll take a quick commercial break here. Up next, we connect with Nagaraj Sethi of HDFC Securities for some technical trading ideas. Stay tuned. Coming up.
Welcome back. So it's a subdued morning, as the implied open was indicating. We got that gap down 100 points, and as of now, there are no buyers. But let's see. It's very early in the day, so we'll see. Let's ask Nagaraj Sethi what the approach should be. Nagaraj, it's been a market which is working in very tight ranges, tight goalposts. Would you be a buyer of this dip today?
Yes, obviously, market still, though showing a nervousness at the higher levels of around 26,000, the overall trend, the reversal, what we have seen last couple of sessions is intact, and I'm expecting around 25,900 to 800 is going to be a strong support for the market, and eventually we could see Nifty bouncing back towards 26,000 levels and higher. The next upside target to be watched in the near term for the Nifty would be around 26,300.
Okay. Nagaraj, what about individual stocks? What are you trading today?
I have two stocks on the long side. First one, Usha Martin. Chartically, Usha Martin has been in a consolidation phase over the last couple of weeks. The larger degree of uptrend remains intact. Higher tops and higher bottoms is there or visible on the daily, weekly chart. Currently placed to move above the consolidation Currently trading around 448, 449. One can look to buy at this point of time. 475 would be the immediate target for the near term, and one can place a stop loss at 435. Second one is from a metal front, NMDC. NMDC was moving in a narrow range over the last couple of months and currently placed at the edge of breaking above the important resistance of around 78.50, 79 levels. The overall chart pattern is looking positive. I'm expecting after the consolidation, eventually this stock could give a decisive upside breakout of around 78, 79 levels. Currently trading around 77.90, 78. One can look to buy at this point of time. Immediate target would be around 83, and one can place a stop loss at 76.
Okay. All right, Nagaraj. Thank you so much for that. By the way, I just want to point out that Wakefit is now down about 8.5%. Such a different listing, right? Just last week we had Meesho, and what a listing Meesho was. You know, from 100, the stock went to 145, 150. Wakefit is the reverse. It's very, very subdued. But I guess we go back to that valuation argument, Prashant, that we were having earlier. I mean, at 80 times FY26 earnings, I mean, how much does it leave on the table, should I say, on the bed for this one?
It's a little sleepy this morning, right? Wakefit, 8% lower. And we'll have, actually what we'll do is we'll put up a valuation table, as we often do, for many of these newer listings. On day one, where do valuations stand compared to, I mean, whatever is the closest comparable in that sense. Amber is what we're going to talk about. There was an analyst meet. Management is reiterating strong guidance. Upasana is here with that. Upasana, over to you.
Let's straight up look at the analyst meet takeaways. Now, management has reiterated their guidance, implying a strong 13 to 15% outperformance to the industry in consumer durable segment. Now, in FY26, company has given an overall guidance of 10 to 15% growth in RAC and 35 to 40% growth in electronic segment. Now, company is seeing a sequential improvement in the demand in consumer durable, while there is still channel inventory in the system for RAC, and mind you, 1st Jan onwards, the new energy norms will also kick in. Now, electronic division, the company says that the growth here will outperform the other segments, led by new client additions and even acquisitions. And company has given a strong growth outlook in other segments over the medium term. Now, overall, if we look at the main focal point of the discussion was the company's electronic segment. So overall, we are seeing a positive commentary from their analyst meet, and certainly revival of demand is what the company has indicated.
Okay, all right, Upasana, thank you so much for that. Well, with that, we have to get into a quick break, but coming up on the other side, our special segment, It's the Economy. Today, Lata speaks with Bhavesh Jain, CEO of credit scoring company CIBIL, on the quantity and quality of loan growth after the GST cuts.